Everything on the grocery shelf looks familiar: milk, bread, eggs, pasta, but the total at checkout makes your eyes widen. Picture a grocery cart that once cost $20 in 2020, now needing $35 in 2025. A gas pump that read $2.50 a gallon now reads $4.50. A rent bill slides across a kitchen counter, its number noticeably higher than last year. This invisible thief, eating away at your wallet, has a name: inflation. In this short, clear guide, we'll break down why your money buys less, what causes inflation, how it evolved through the pandemic years, and practical steps you can take to protect your savings. Visuals will show simple 2D characters and clean 3D charts, while a calm, trustworthy voice walks you through each step. Start here. The feeling of sticker shock is universal. But rather than an emotion, inflation is an economic process driven by several clear forces. Think of inflation as a rise in the general level of prices across the economy, not just one item, but many items together. When prices rise, each dollar buys a smaller slice of goods and services. Let's unpack the core concept with a simple, clean story. Imagine 3 neighbors and a small corner store. Each person has $100, and the store stocks a steady amount of goods. Everyone can buy what they need. Now imagine a bonus arrives. Every person gets an extra $100. People feel wealthier, they buy more, and the store sells out faster. The store owner notices demand rising and increases prices. Suddenly, the same groceries cost twice as much. Money supply went up while the quantity of goods stayed the same. That gap between money and goods is a key driver of inflation. This neat equation, more money chasing the same goods, captures the basic idea. But the real world is more nuanced. Economists group inflation causes into 3 main types: demand pull, cost push, and wage price dynamics. Each has its own story and visual pattern. First, demand pull inflation. Picture stimulus checks raining down, people suddenly with extra cash in their pockets. Consumers rush to buy durable goods, appliances, cars, or even simply go out to eat after being cooped up. With stronger demand and limited immediate supply, sellers raise prices. A simple line graph shows inflation rising as demand surges. The curve climbs. This is classic. More demand than supply means upward pressure on prices. Next, cost push inflation. Here the story starts with supply problems: a cargo ship stuck at a canal, factory closures, or sudden energy price hikes. When essential inputs like oil or shipping costs rise, it becomes more expensive to move and make goods. Producers pass these costs to consumers, and prices increase across many sectors. Imagine oil, truck, store, consumer. When any link in that chain breaks or gets pricier, the final price climbs. Third is the wage price spiral, a cycle where rising wages and rising prices feed into one another. Workers push for higher pay to keep up with higher living costs. Employers raise prices to cover higher labor costs. That leads to more demand for higher wages, and the spiral can continue. Visualize a circular arrow: pay raise, penure, higher prices, new pay demands. Often wages lag behind prices, so real purchasing power can still fall even as incomes rise. To tie these mechanisms to recent reality, let's walk a short pandemic timeline. A horizontal timeline shows the years from 2020 to 2025. In 2020, widespread lockdowns led to lower demand for many services and, in some categories, falling prices. In 2021, massive fiscal stimulus and pent-up demand combined with ongoing supply constraints. Governments injected trillions to support incomes and keep economies afloat, which pushed demand sharply upward. 2022 brought additional shocks. Energy price spikes and geopolitical conflicts created supply constraints, and inflation peaked. Then central banks raised interest rates to cool spending and borrowing. By 2023 into 2025, inflation moderated and moved closer to target levels. Those interest rate hikes matter. Central banks use rates to influence borrowing and spending. Higher rates make loans more expensive, dampening demand and slowing inflation. Lower rates encourage spending and investment. Think of the rate dial as a thermostat. Turn it up to cool down an overheated economy. Turn it down to warm it up. During the pandemic, the dial moved from near zero to higher levels as central banks fought inflation. So what's a healthy level of inflation? Many central banks target about 2%. Why 2%? It's a Goldilocks zone, not so low that people hoard cash or wages and prices get stuck, and not so high that purchasing power erodes rapidly. At 0% or deflation, consumers might delay purchases, expecting lower prices later, which can stall economic activity. At high levels, say 9%, everyday essentials quickly become unaffordable. A three-panel visual makes this clear. 0% tends to freeze spending, 2% supports steady growth, 9% is painful inflation. For perspective, on the extreme end, let's look at hyperinflation, where currency value collapses almost overnight. Hungary in 1946 and Zimbabwe in the late 2000s are stark examples. In Hungary, prices rose so fast, people needed wheelbarrows of cash to buy bread. In Zimbabwe, banknotes with astronomical faces became worthless. These episodes show inflation taken to extremes. Savings evaporate, normal market transactions break down, and basic trust in money disappears. So where does that leave everyday people? There are practical, clear steps to protect your financial health without needing deep economic expertise. First, invest in assets that tend to appreciate over time, or at least keep pace with inflation. Stocks, broad index funds, and real estate historically offer better long-term protection than cash, sitting in a low-interest account. Second, be proactive about income. Negotiating raises, diversifying income sources, or upskilling for higher-paying opportunities can help your earnings keep pace with price rises. Third, budget with expected price increases in mind. Build flexibility by projecting modest annual price growth, so your financial plan anticipates not just current bills, but likely future changes. Let's bring this home with Lily's small, everyday story. Visualize Lily reading her receipts and doing a quick monthly check. She shops mindfully, comparing prices, and shifts a bit more of her savings into low-cost index funds. She asks for a cost of living adjustment at work and adds a small side gig tutoring once a week to diversify income. Her budget assumes a 2 to 3% annual rise in key categories like groceries and utilities. None of these moves are dramatic, but they collectively shield her household from gradual erosion of purchasing power. Back to the animated charts. 5 clear visualizations help the message stick. First, a simple money supply equation animation that ties more money plus limited goods to inflation. Second, an inflation timeline from 2020 to 2025 that shows the pandemic story arc. Third, a wage versus price comparison chart that highlights how wages often lag behind inflation.